Good morning, everyone. The 2025 forecast for New York City's real estate market indicates a dynamic landscape influenced by various factors. Mortgage rates. Expect 30-year fixed mortgage rates to hover around 6% throughout 2025, with potential brief increases above 7%. This trend may impact buyer affordability and demand. Interest rates. The Fed Reserve's monetary policy suggests a higher for longer stance on interest rates, which could influence borrowing costs and consequently real estate transactions. Co-op popularity. Co-ops are anticipated to gain popularity this year among buyers seeking more affordable options compared to condominiums. And suburban influence. High suburban home prices may drive more buyers back to the city, increasing demand in urban neighborhoods. The luxury market segment is expected to experience renewed activity, partly due to projected increases in bonuses for professionals, leading to higher purchasing power. Amenities. Both renters and buyers are increasingly seeking properties with amenities such as outdoor spaces, pools, gyms, and in-unit laundry, indicating a shift towards prioritizing lifestyle conveniences. Overall, New York City's real estate market in 2025 is poised for nuanced shifts with varying impacts across different sectors and property types. We're going to discuss all of that today, and at the table with me today are Ben Willig is Director of Sales from Elegran Forbes Global Properties, Patrick Mills from Core, and Mike Bussey from Real New York City Apartments. And they join me now to discuss. But first, let me welcome my listeners and viewers from across the United States and all around the globe. I am Vince Rocco, and this is Talking New York Real Estate. So let's go behind the headlines and get the real story, the state of our industry.
Hey, it's Stephen Bailey from Roadway Moving and Storage. As an official moving partner of Brown Harris Stevens, we know that your clients deserve more than just a move. At Roadway Moving and Storage, we turn moving into an experience they will love. From specialized services to a white glove treatment, we've got it all covered. When you choose Roadway, you're choosing a peace of mind for your clients. Plus, our referral program is the most rewarding in the industry. Want to learn more? Shoot me an email at steven@roadwaymoving.com or visit roadwaymoving.com.
All right, everybody, we are back. We're going to talk today about our forecasting, our predictions, I'd rather call it. We're going to close out what our thoughts were about the 2024 market, which kind of were all over the map, and then again, eventually get into what we think, where we see the new year 2025 heading from a buy perspective, a sell perspective, an investor perspective, because every year in this town, New York City, things change. We just got through an election period, so let's see where, starting now, our spring season starts now in January, typically end of January. So let's keep our fingers crossed, and wish and hope for the best. I'm very optimistic for the start of 2025. But Ben, let me start with you. So, what do you think are the most significant changes in the real estate market that we faced in 2024, and how did they affect where we may be going in 25? I mean, 2024 was quite the year. I mean, on the very high end, business was better than usual, but that's not more than 5% of our industry. So the rest of the industry kind of dragged along. What do you think happened in 24?
Well, I have some very fun stats regarding all those categories. So
let's hear them.
I think in 2024, there was obviously the big change with NAR and what went on with that in August. But then you also have, these unintended consequences from that. And I think people forget that business still goes on even in the face of change, and change creates great opportunity. So I think, everything and the way I'm looking at 2025 is really like a Venn diagram. You can have two things coexist at the same time. You can have a lot of great challenges and a lot of great opportunities and growth. And I think we saw that in 2024, because when you look at everything, it was actually a more successful year in some pockets and some ways. But for a lot of people with the challenges and things like that, it either caught them off guard, it was a lot to manage, maybe threw off businesses, and some people you talk to very, very challenged. So if I could take a second on some interesting data, right?
Please do.
Really speaking to these unintended consequences. Historically, as a brokerage, we always ran at it's called 2.75% on the buy side commission. I didn't even look at it for a number of years because it was so consistent, right? Some 2.5, some at 3. In the 3 quarters preceding the August 14th in 2024 change, we started decreasing. And I didn't realize this until even after the fact. 2.6, 2.5 and change. It went down the quarter before to 2.32. I looked this morning right before coming on here. Since that date, we've been up above the historical average at 2.88%. Oh, where everybody thought coming out of that change was going to drastically, put us to the lower side of things. So as I look ahead, it's again that Venn diagram of what's the challenge coming at us, and with all these things, there's the other side to the coin, and these unintended consequences and things that might happen. So there's a lot of interesting ways I think that I'm looking, both at the year that was from that lens and where we're going from that perspective. So.
Right, I agree with you. The perspective, though, of, say, the buyer, and then we're going to talk a little bit about the renter, but from the buyer, in 2024, I always say when things are not right in their world, okay, if there are a lot of unknown, as we talked about before the show started, they kind of run home, get under the bed, lock the door, and don't move, okay? They just wait it out and wait it out and wait it out. Sometimes I say, what are you waiting for? What do you think was going through the minds of the buyers based on what you said now caused them to kind of stay home with that door locked and really not show up anywhere? I mean, open houses were not very well attended for most of the year in 2024. What were their thoughts?
So that is a great question. And those buyers, I'd argue, are missing out on a lot of great restaurants in New York City. So they probably should get out from under the rock they're living in. And I'm a big foodie believer in that. So let me, I think,
Me too.
Break that down. So the most interesting data I think that I also saw last year was going into and coming out of the election. And, we were, let's call it at the end of the summer, probably peak ambiguity or uncertainty.
Correct.
Right? You had what was going on with the NAR settlement. You had maybe rates were going to go down, maybe they were going to go, back up. Conflicting economic data, those couple months. Add in the geopolitical uncertainty and the election, and you got a lot of that leading in. One of the stats that I look at, let's call it the leading tip of the sword, is number of inquiries. We have a large number of agents, and I see enough, data come into us where I can see the number of inquiries coming into our system. It went down by about 30-40% or so coming into the election. We popped up actually above pre-election levels after that. The even more interesting data point is we've been trending 30-40% higher now on those number of inquiries, and the middle of the funnel, which is like after someone inquires, right? Do they stay under a rock or do they actually get active in the market? That's gone up by almost double. Not quite, just a little bit under in terms of those middle of the funnel, statistics. So when that uncertainty comes down and buyers' perception of things, I think is like the biggest part. You've had a lot of these factors get removed over the last few months. And for the first time since 2022, we've had 3 consecutive months that are above the historical average demand, contract signed and sales. And we haven't had that for 3 consecutive months since 2022, the early part of 2022. So, I think those are a lot of the reasons and things going in, and you saw that in the data with the consumers. But coming out of it, we've come out with a whole lot of strength, and you're seeing that both in, the first few steps of that process. So,
Patrick Mills is here from Core Real Estate. So, Patrick, from in your orbit, in your world, a lot of people were telling me, and I saw it myself, that December was, a pretty decent month based on what Ben was just saying last 3 months. Why was December so hot? And what were people anticipating? Post-election, potentially, okay. But we were still in that quagmire of not really knowing what to do. In my world, future business starting January and February started to trickle in for me to sit back and say, okay, wow, maybe first quarter of 25 will be pretty decent. Let's hope so. But in your orbit, what about December? Because I was hearing it from so many agents that December was like popping off the charts.
Yeah.
Normally around a holiday time, it's dead.
Correct. Historically, December up until, mid-February bonus season, it's historically crickets. And even if you're not looking at data every single day, like Ben here, you felt it. And of course, as we know, every election cycle, no matter who wins, no matter what side you're on, the removing that ambiguity for the psyche of a buyer, even for sellers, is huge. So yeah, to your point, since a day or two after the election, I started getting way more inquiries, phone calls, emails. I had something go into contract a week after the election, and spent most of December, instead of running around to holiday parties, literally showing every single day in December.
Yeah.
I'm still in Brazil at this point. Usually, as long as I possibly
it's a
can.
big vacation time
Because
especially in our
it's
business.
usually crickets right now.
Yeah.
This year I decided, because I felt, coming off of the election, I felt that business was really picking up, and we all know if we have business, you run with it.
You catch it when you can.
So
You
I
don't
sent
live it.
my husband to Brazil. He came back Sunday, and I have been, aside from 2 days over Christmas, I have not had a day off. I had a showing the next morning after Christmas, and I took a couple days off in between. But even on Christmas Day, I was literally replying to inquiries. Hey, can you show?
Yeah.
New Year Day, I had 3.
Eat your turkey. Leave me alone.
New Year's Day, I had 3 real showings. And one of them turned into an accepted offer. And that's just never happened before. I've never been so busy in the first 2 weeks of the year, the first 2 weeks of January. Probably because I'm usually in Brazil, but this year has just been nonstop.
So you feel that, the way you started the year, based on how you ended December being pretty decent, it's going to continue at least through the first quarter?
Yes. I mean, we all have to be optimistic, right? To survive in this industry.
And real, but I happen to agree, though, that I think we're going to be there.
A healthy balance of both.
I always look out for landmines. I came into the workforce in 2008, so I'm always looking behind my shoulder.
Same.
2008. Okay, there we go.
My first week in real estate was Lehman Brothers crash.
By the way, it's funny you say 2008, and I've gone on record, and even when I'm teaching school, I say my best years in real estate were 2009 and 2010.
Yes, yeah.
The best ever, because you get into it, and we were doing fine, and then all of a sudden the financial market crashed in 2008, and you thought, oh boy, here we go. But perseverance, push forward, and I'm telling you, I was selling a new development at the time, flying off the charts, and people kept saying, but what are you doing? I'm like, I don't know, but I like it.
Mr. 505.
And it's continuing, correct.
Yeah.
So, but the best 2 years ever. So even in
With the challenges.
troubling times, with all of the challenges, you can
Those
still make it go.
opportunities.
Mike Bussey, so we're talking about business in general in 24. You have a significant online presence in rentals. Tell us from your perspective, talk a little bit about the vacancy rate, the prices of rentals, how they've gone up over the past 2.5 years, and where, the market ended in 2024 from a rental perspective.
Yeah, absolutely. So, as we know, the rental market is always going to be very cyclical. 2024 was a really interesting year because, we saw 21, 22. We saw 21 was basically the bottom, 2021.
Yeah.
22, it really came up. I remember there was effectively no vacancy. Like, we were renting based off of floor plans. Thankfully, we had a database of videos so we could actually show clients the apartments and the buildings. Now there is a good amount of inventory sitting. The truth is, I just don't think it's very good inventory. Prices are still extremely high. Clients are very disappointed. When I have clients coming over from London and they get sticker shock, I know that there's an underlying problem. So, I can't imagine rents are going to go down too much, but the rental market is definitely healthy. There's a lot of new devs coming up that are definitely putting some pressure on the market. If we look at, I love the financial district. That's my neighborhood. That's where I live. If we look there, we have, something like 2,000 new luxury units coming onto the market in a 6-month period.
Coming on.
Yeah.
Now.
So 25 Water is going to be 1,350 units.
25 Water, right.
55 Broad just opened up. Right. That's about 500. There's a lot of new, and then there's some on John. Pearl House just opened up. I know of a few others that I can't really chat about, but there's a lot coming to the market. So hopefully that takes a lot of the pressure off.
But did you, in your book of business, see renters hesitate in moving forward and pulling that trigger, as you say, and making a deal like we saw on the buy side? Or did they just automatically say, hey, you know what? I really can't afford to buy right now. Interest rates are high. Monthlies are very high. I might just renew where I currently am, or go out and find something new. Was there more of that in 24, do you think?
Renewals were high. People were nervous. again, the election definitely played a role. And to your point, a lot of people that I spoke with in 22, 23 who said, hey, we're getting ready to buy, our lease ends in, mid 2024, so we're just going to buy. They changed their minds completely. They were like, we're going to wait a couple more years and then see how that progresses.
The trend was for a while on the rental side, up. And, at one point in Manhattan, I think the average price from a one bedroom got as high as $5,200 a month. I could be off by 100 or whatever.
Yep.
Yeah.
It's trended down, right? It's trended down a little bit more. Where do you see the trends going into the next year based on where we came out of 24? Continuing to go up, staying flat, or going down? I don't believe they're going down, but
I wish they would go down. What
goes up doesn't come down in this town.
I would expect them to relatively stay flat, if not increase slightly. But we'll really have to see. It depends on how people are feeling, how the economy continues to trend. Because, now we're looking at it, it's getting so expensive that people really are considering going outside of New York City.
Mm-hmm.
Hoboken has become very popular, which is now extremely expensive.
Correct.
People are more and more willing to go deeper and deeper into Brooklyn. So, Manhattan, New York City real estate as a whole, we'll just have to see how people feel and how they react to the market.
Ben, do you think there were any lessons learned in 2024 as we conclude that year, put it on the shelf where it belongs, whatever? Any lessons learned by buyers or renters or developers or investors that may be significant for them going into 2025? What might they have learned?
I think the biggest thing to learn is do your homework and don't wait. Right? The best time to buy was yesterday. The second best time is today. And that has played true for me and my own investments. So I think there's a lot of things going on, and you need a great advisor to help to educate you on all these points. And like what Mike was saying just now, like where is that that rental market going to be going with things? But we are so supply restricted and constricted here in New York City.
Correct.
When you look at the big macro picture, right? Because there's our micro market of things that are going on, and there's the macro market, which has impacts. The macro, both of those are incredibly strong. New York has a lot of co-ops. You're not going to get a lot of rental inventory with co-ops. There's a ton of landmark districts. Not a lot of places they can build except for places like Financial District and things like that,
right.
the FIDI. So when you have a lot of these really good factors working for you, you want to make sure you don't end up in a bad situation in a building that's not paying its taxes and self-managed and all this, sort of stuff if you're an investor, and really do your homework on spots. So I think when the people who've made those investments have done well, and the people who've made, smart investments and jumped in, because we're right at that tip right now where we're probably going to be getting those, FOMO buyers, and folks like that coming in, like the fear of missing out, like, oh, now the news is reporting on the market being good. Now I see the open houses packed and missing out on things. And that's this other accelerant to the market. And people are going to say, well, I wish I bought in 2024, right? So I'd say be diligent, do your homework, staying with my trend of there are opportunities in the challenges, not willy-nilly, but, be intelligent both. And when you look at, I think, all those factors going on.
Yeah. Patrick, from a developer perspective, we did not see a lot of new developments out there, either rental or sale, coming to market. Why was that in 24? For the same reasons that buyers had with interest rates and freezing of money, and because as Ben just said, lacking inventory here, we need property to sell.
Right.
And we always depend on that new stuff to come to marketplace.
Yeah.
What was the bottleneck?
Well, the reason why there's little to no new development in the pipeline is because it's become almost impossible for a developer to see a return on the investment. We need many more incentives for developers, like the 421A, and until those incentives.
And I don't think that's ever coming back, by the way.
How are your? So I totally agree. Like I have a lot of developers I work with, and it was so funny. I think it was June of 22 or whenever it was when they had to get a piling in the ground in order to still be eligible for 20A. I had these Chinese developers, and they were like sending crews rushing to get the stuff before it was going to run out.
Break ground.
I'm curious, Patrick, in your conversations, the two things impacting it, because you look at the applications for new dev, it's gone it's plummeted since the 421. It's gone down again, leading to more of that supply restriction story. The two things that you might have going are the 485X and the City of Yes changes, which actually has some interesting, very potential stuff. So I'm curious what you're. I mean, still the cost of development, and for something to pencil out as an investment here, it's like in working with our developers, it's very hard to get that. So I'm just curious and how those two things in your conversations have been impacting.
I mean, I think the City of Yes is definitely a step in the right direction.
Yeah.
I don't know if any of us really have a ton of faith in, as much as we love this city, a ton of faith in the really enforcing and prioritizing the initiatives that City of Yes is trying to accomplish.
City of Yes is good and bad, and there are a lot of potential obstacles with City of Yes. It's not really addressing every portion of our housing supply problem, especially from an affordability perspective, okay?
Mm-hmm. Right.
But getting back to the developers, I mean, is that something that they can jump into and say, hey, maybe this will work for me?
Hopefully.
Or maybe I can get some more funding.
What I've seen is, I think Patrick hit the nail on the head, is that it's like a step in the right direction.
Yeah.
And there are pockets we've gone through the detail in some of the aspects of City of Yes. Yeah. And you can find some things that, like, if that goes through, that's going to open up being able to do these units and actually,
Correct.
Now my cost to build is $150, $200 per buildable as opposed to $600 or $700, right? And that's a big difference that developers have been looking to see, because with the cost of materials, which has kind of leveled out and come down a little bit, but also the interest rates for them and construction loans and all that type of stuff, like, you need something from the political side if you want more housing.
Oh, 100%.
With this. And right now you have to look at it with a magnifying glass to see those opportunities, and it's not incredibly obvious where things would just start really popping off in the city. So,
and then it's also finding land that is desirable and affordable. Like, if you're going to build a new development,
if it even exists.
Right. Well, there's like these, from what I've looked at, these pockets that if they go through, people who are ahead of it and developers who are ahead of it, can get ahead of the owners who might have those certain expectations of what their land value is. And that's how I think there'll be a little bit of opportunity, again, step in the right direction. But then once I think landowners realize, like, maybe what they have and they try and get greedy with it, it then creates another issue. Yeah. So
affordable.
Exactly. All right, we have to take a break. On the other side of the break, we're going to continue talking about the end of 2024 and then our predictions for what's going to come in 2025. Don't go anywhere. This is Talking New York Real Estate on the More Network. We will be right back.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
We are back. Okay, so let me ask you guys, where were any noticeable shifts in demand between Manhattan, Brooklyn, Queens, or the Bronx during the past year in 2024? Was Manhattan busier than Queens, Queens busier than Brooklyn, on and on and on, the Bronx? Where was a lot of the activity or lack of activity in all of our boroughs?
So I guess
everybody jumps to Manhattan quickly, but that's not always the case.
The way I've always viewed the boroughs, and I think I've been in it long enough to kind of see this, is it's always just like a rubber band. It goes out and it comes back in. It goes out and it comes back in.
Correct.
So I think, when Manhattan gets too expensive, that rubber band goes out. And then you see the boroughs get to be almost as pricey as Manhattan, and then people are like, oh, well, I'll just live closer in the
happened in Brooklyn,
in the city. Right. And so, I think in the 21 to 20, where are we on that rubber band cycle, I think is the question with that. I would say, Brooklyn was popping off way more post-pandemic than, Manhattan. Arguably, by a lot of the metrics, it still probably had a little bit more strength in the market than Manhattan. However, when you look at it, Manhattan has definitely come back, a little bit. Queens was always like the sleeper, and just very much has, like, when you look at all the data, like one of the most applications for new development and new housing permits is actually in Queens, which is very interesting. So, I mean, Long Island City is way different, but even other areas of Queens have changed completely over the years.
Astoria has become quite the place.
Yeah, so that I think is like a real some of the biggest growth metrics in the city out of the boroughs are actually in Queens. It was a lower starting point than the other boroughs, but you have that. But now the whole city and Manhattan, as it relates to the suburbs, looks affordable, and we're seeing more and more over the last year or two that the people who left during the pandemic. House prices and supply nationally still remain high, very challenging, and that difference is not so different from the city. So that influx to Manhattan isn't just that rubber band from the boroughs; it's also coming from outside back in.
Yeah, I read something at the top of the show where the higher cost of housing in the suburbs in New York City might be pushing people to reconsider and buy here in New York. I have a differing opinion on that. My whole family is up in Westchester, and I spend a lot of time up there. And quite frankly, yes, there's a lack of inventory, but the minute something goes on the market, it is gone, absolutely gone. And I don't know how anybody can compare pricing in Westchester or anywhere else in the burbs to New York City. So I question, and please correct me if I'm wrong, I don't know how anybody's going to come back from the suburbs and want to buy in Manhattan when the prices are out of control.
In some of the conversations I've had, maybe it's not as much of that, but maybe it's the couple who's looking, maybe with a young child who's looking at moving out into Westchester and is like, well, wait, why am I going to commute when that price is not enough of a discount? Mm-hmm. I'm just going to stay in the city. And I've had more of those conversations recently, with people. So it's maybe a little bit of that coming back in and the empty nesters, and it's cool with that. But then you have that aspect.
Hey, we're all here if you want to come back to the city, boy. We're all here. But I'm just a little skeptical. It's not saying that my opinion is correct, right? I just... for the price of one of my studios on the market, you could buy a 4-bedroom house in the burbs. So it's kind of like, I get the commuting. I get it. However, I don't know. I'm not living in the burbs, trust me. Okay, that's not for me. But I'm just wondering what that all means. From a rental perspective, are you seeing people run out of this town, Mike, or are they coming in and saying, all right, look, the cost of mortgages, the cost of interest rate, common charges off the chart in 2024, only to go higher in 25. Are you seeing people say, hey, maybe I need to stay where I am?
I'm seeing more and more people come back to New York right now, which is really interesting from a rental perspective. And I think this might just be my clientele, but the only time I really see people leaving right now is they go, I have an emergency, I have to get back, I have to move, XYZ. I had one guy who was like, I'm moving back to the Midwest just because my job is remote, and the dollar is basically 3 times stronger out there. But
well, there you have it.
No, I see a lot of people leaving right now just because of space constraints, and I think that a lot of that has to do with my age group. I'm 24. I know a lot of people in my general age, and they're starting to get married. They're starting to have kids, so they're looking at the city right now and being like, a 1-bed and in Manhattan is $5,000. Maybe I should go into Jersey or maybe into New York. So that's a little bit of what I'm seeing. But no, from the rental market, it's pretty normal as always.
Purring along, Patrick. So, and then we'll close out 2024 after this last question. The interest rates in 2024, starting back in 23, probably end of 22, we're on a steep climb. Okay. And as Ben mentioned before, and we talked about before, buyers kind of hesitated and stayed frozen in place because of the unknown, not knowing what was happening. Did it really affect our business as much as we want to say it did, or were there other contributing factors to why 2024 wasn't as robust as we wanted it to be?
Yeah, I definitely think that the interest rates have a massive effect on our business and bottom line. There's no arguing that or debating that. But what I have seen is people, like most New Yorkers, were driven, we're impatient, and we
can only keep New Yorkers down for so long.
Exactly, and we get what we want, even if it takes a couple of years. We do. I mean, New Yorkers, we don't come here to just like schlep around and no, we work hard. We play hard, and we want to have a nice home. So although there's been a lot of hesitation and with buyers because of interest rates, I am starting to see, especially the last quarter of 2024, buyers just give in and say, you know what, I live once. Yeah, I'm going to stretch as far as I can, which I always think is a smart idea when it comes to real estate, because I don't want to live in this. I don't want to live in a rental any longer. I don't want to keep paying a landlord's mortgage. I want to do it for myself. So I am starting to see, and having a lot of conversations with people who are just over it, moving on, accepting the reality. It's become the new reality, and there's little ambiguity, as we've mentioned before. Ambiguity is the most difficult thing to sell, but who are just accepting the reality and pulling the trigger.
Well, that's it, accepting reality. Ben, so you're a leader in sales management. You've been in sales on the buy side for many years. You're also an investor, okay, in your own personal life. Where do you see, again, in 2024, I believe the investor community kind of took a pause. So moving into 2025, do you see that investor activity picking up? First of all, why the pause on the investor side? And do you see that picking up going into 2025?
Yeah, I think when you have rates, what you saw in the investor community is the cap rate really started to elevate quite a bit, and the perception of where that should be, didn't necessarily fully catch up. So we do actually right now have some investors exiting some multifamily and things like that. When you look at the costs in New York City back in, I think 07, 08, the average cost for, maintenance or common charges and taxes was around $1,800 a month or so. Today, it's closer to about $4,200 a month. So over that time frame, that's a significant increase in the carrying costs. You have a lot of buildings with assessments. Add in the interest rates, on top of that. And as Mike was alluding to earlier, you have this leveling off in the, rental market, right? It's still going up a little bit, but definitely like a leveling off compared to the last few years. You could easily hit a home run if you have rents that are going to be popping off. So good market for investors maybe 2 years ago, 3 years ago. So right now, I think the people who are going to come in, New York is always what I would, classify as almost like a triple A grade bond, right? In terms of an investor in New York City real estate. You have those supply areas, so you have a lot of downside protection because of the supply. And so the other thing too is you have to anticipate that I'm not going to have a lot of work to do because I have doormen and supers and all these other aspects. So it's a pretty hands-off investment. So, and with a large probability and a good probability of equity upside, which you don't get in other markets that have better cash flow. So those long-term investors who understand, I think, all those dynamics at play and who are looking for capital preservation and equity appreciation, there's only been 2 other times in the equities market that we've been over a 30P ratio besides now. And today it's dipped a little bit to like 29 and change. But those are 08 and 2020. And you look historically, like we're very, very lofty in terms of other markets with those types of things. So again, some of the savvy investors look for diversification, equity preservation, with that chance of large potential upside in the equity, in the rents, over the longer period of time.
Excuse me, Patrick. I saw an email, I think yesterday or the day before, come across my desk where an agent was carrying on about how wonderful an 11% cap rate was, and you should come and see my property and blah, 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 blah. Now, I remember when investors used to crab about 4 and 5% or 6% because, 3 and 4% was the ideal. 11% in your world. Are investors accepting something like that these days, or are they kind of digging in and saying, hey,
is that an apartment with no windows at 11%?
Maybe, yeah. In this town, who knows? But what gives?
I don't know what gives.
I mean, 11%. I mean, is anybody in your world thinking that this is okay?
I mean, it's not reality. I mean, it's just not. I've actually never.
I didn't either until yesterday. I don't. What is the actual cap rate?
I think the norm is a lot of people are listing between that. Let's call it let's separate multifam and luxury market. So in multifam, you're looking at people listing between 5 and 6, and more is trading between 6 and 7, right? So that's typically, I think, what you're seeing right now. Still in the luxury market, all costs bake in and things like that. You're still at those probably about 1% less in each of those, categories at least. Again, rough numbers, every market I think is a little bit different. But if you're looking at, cap rate is a function of risk reward. If you're going to a much higher cap rate, that's why I said it was an apartment with no windows. There's some other major risks.
It could have walls of windows, 11%.
Are they building, a methadone clinic across the street? Are they, what's the, what's the risks that you're taking on to get that higher, percentage? That's where a lot of times people confuse lower cap rate not being as good. Again, I liken it to downside protection, AAA grade bond, and actually longer term security with some of that upside potential. So you need to know, it's not always just about more cash flow and higher cap rate, because there's something that's driving that there.
100%.
There's always something for sure.
Yeah. Well, indeed. But when I saw that, I thought immediately, there's something wrong with that.
Yeah.
It doesn't make any. But this agent was putting his spin on it, like, whoa, come and see this. And I thought, okay, maybe
must be a catch. Yeah.
Maybe I'm missing something, but I got to ask that question tomorrow on the show.
Well, there's to my point of homework, right? There's when I've looked with investors, there's two types of people who are listing cap rates and investment properties. There's the person who, and both of them don't know anything, and there are some people in the middle. The one who doesn't know anything that completely overlists the cap rate is pulling in crazy rental numbers that are never attainable. And if you really know the rental market, if you're working with someone like Mike, he can go in and be like, no, this is BS.
Yeah.
This is what you're actually going to get. This is the real cap rate. And to the flip side, there's the people who are always in commercial, don't really know what the rental market's doing, list what the rents actually are, and you can actually extract a much higher cap rate if you really know the rental market and things like that. So, it sounds like that was probably more the former BS scale as opposed to the latter, but
potentially, and I agree, Mike. Though, from your perspective, and even on the buy side, what neighborhoods do you think are going to experience the highest appreciation in property value coming this year into 2025? Whether it's a rental property, new development rental property, whether it's a buy situation, what neighborhoods do you think are going to show the most appreciation from, say, the past through 24 and going forward in 25?
Truthfully, Vince, I wish I knew. I would be putting money there in a heartbeat. I got to be honest, I truly just don't have a great answer for that. In terms of rentals, look, if I'm buying, I would probably steer clear of the financial district just because I know it very well. There's so much new rental inventory
down there.
Yeah, so I would maybe steer clear of that. But if we're talking blue chip, I would still pretty much always go Tribeca, West Village, Greenwich, these tried and true neighborhoods. You really, really just can't go wrong.
I would agree with that, but I also get confused sometimes when I think about it. When I was reviewing this morning, I thought, well, we are in a marketplace in New York City where, anything is possible and anything can go, and depending on the price, right? Even if it's in a neighborhood that you don't necessarily really want, working with buyers, they kind of tend to choose that because the price is right. So, Patrick, what, in your opinion, where do you think the most appreciation in property value is going to take place? Where not going to go down, but, and not necessarily a jump up immediately, but a steady kind of climb to higher prices.
Yeah,
if we can even say higher prices.
Yeah, I definitely agree with Mike here. The blue chip neighborhoods are always a smart idea if you can afford them. But I'm usually bullish on blue chip adjacent. 10 years ago, we didn't really know what Hudson Square was. It was this
made up neighborhood.
It was this made up neighborhood, not Hudson Yards, Hudson Square.
Yes, Hudson Square. Yes.
Some people get those confused.
Well, even Hudson Yards.
Hudson Yards for sure. That's a different conversation.
Train tracks.
It's train tracks.
Yeah, literally.
But Hudson Square has proven to be definitely one of the strongest mini pocket neighborhoods in the city. A lot of the new development there the last 5 years or so, you're seeing massive return on. People are trading a year or two after they've closed and seeing 50% return. Crazy numbers. Another blue chip adjacent, which I've always been bullish on. It's my neighborhood. Do a lot of business. And Hell's Kitchen. There's so much value there if you're able to wrap your head around it. I love living there. I've lived there for over 10 years. It's not for everyone, but if you can wrap your head around living there, along closer to the West Side Highway, 11th Avenue. I mean, there's some
It's easy
great
in and out.
opportunities.
Easy in and out, absolutely.
And there's just so much going on there. Great restaurants. You can walk back and forth to theater, and just an overall nice vibe. It's a nice sense of community. A lot of people who've been there their entire lives, so you do have that great sense of community. And again, fantastic value. I mean, what you can get in Hell's Kitchen right now compared to pretty much anywhere else in Manhattan, even Brooklyn. I mean, it just doesn't exist anywhere else.
As you know, I stepped into that neighborhood in 2006, for the first time, selling a brand new condo development. And I remember saying to the developer at a table like this, after they were interviewing me to be the director of sales, and I kind of turned this way to one of the developers and said, "But who do you expect to buy there?" And so my manager was like right next to me, the head of development, Mr. Kligerman, and he went like this to me. "What do you? Shut up." I'm like, "I need to know. Who do you think is going to live here?" Because I thought the neighborhood then was horrible. I not only took on the project, sold it brilliantly. Today, absolutely love the neighborhood and still do, still in that neighborhood. But then I was like, "Oh, okay." And he just kind of looked at me. "Did you really ask me that question?"
No, it's an important question to ask. But that block alone it's been on fire the last, I mean, in a good way, the past 5 years.
No,
I mean,
I absolutely agree. I love the neighborhood, and I still sell there, as you well know. But I mean, it's kind of like back then. But that was the situation with all neighborhoods. So going into 2025, I have to wonder what neighborhood's going to pop out better than the next. We got to take a break, though. Maybe we'll answer that question on the other side of the break. Don't go anywhere. We're coming right back.
What do you really need to know about buying or selling a home? First, it's serious business, and it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.
Okay, we're back for our final moments. We were talking about neighborhoods changing. Look at Brooklyn, right? Who would think that Bed-Stuy and Crown Heights and a lot of other neighborhoods there would turn into what they've turned into? Popular, social, good pricing, at least initially. And again, I'm old enough to remember when I first moved into Manhattan 30 years ago, I was like, Brooklyn, Queens, no, not going to happen. Now I love it all because, when I say if I were in my 20s coming into this town for the first time, where would I go? I'd go to Brooklyn. And I probably would stay in Brooklyn forever. I happen to think it's a great place to be. But when you look at these neighborhoods and how they've transformed, and I think going into 25, if we can predict, I think, though, that those neighborhoods are going to continue to accelerate and show tremendous growth and value, both from the rental side and the buy side. But let's talk for a minute about, any impact on office to residential conversions from a rental perspective, from a buy perspective. For a while, that was kind of halted for a whole bunch of reasons, right? And I think most of 2024, developers and building owners were talking about, I'm going to sell the building, we're going to convert it to this, we're going to convert it to that. Where are we with that? Yeah, I know, I kind of agree with you, but translate that for us.
Yeah, so when I've been at the table in a lot of these conversations with developers, and where a lot of the rezoning and things like that was happening was Midtown, which if you look at the French influence down in the financial district, because that was built long before the grid.
When I worked in the financial district, no one lived there.
Right. But those office buildings were a lot easier to convert.
Correct.
Because those streets are much closer, much more narrow. You get cut up a lot differently. You move to Midtown on the grid, now you got bigger buildings, much wider. And so in those conversations, like just to run the plumbing for the number of bathrooms and things like that you would need. And then even if you did, now what are you talking about? A big long room that, would be very dark at the, early onset of it. So then that led the conversation to, okay, almost like there were some, WeWork-ish type concepts that were being thrown out with some of our developers. Like, can you have some central amenity spaces like on the, the floor and carve these up a little bit differently? But then a lot of times it's just more economical to tear the whole building down and build it new from scratch, the right way, because it's going to actually cost more to re-outfit everything.
Yeah.
So you have like all those challenges. There's no easy, roadmap on how to do that. You have some big players taking those bets, and so it'll be interesting to see how those play out, but it's a very small number compared to what people were thinking in the pandemic. And then you have the interest rates and construction and all those aspects again, at play. And again, penciling out for some of these developers, there has to be a little bit more incentive, for them in New York City if we're really going to see that massive push with new housing units. So,
look, I said it before. I worked in the financial district in my corporate life before I came into real estate, and once I used to say, there's not even a place to go get a drink after work here, or forget about a restaurant. We had to go miles and miles and miles to get anything. And then slowly the conversion started to residential rentals, to residential condos. Now, it's a place to be. It's unbelievable. But I used to think, sitting in my office in corporate America in an old, probably 1800 building, who wants to live in a building like this? It's dark. There's no exposure. There's no view, whatever. Typical New Yorkers, I need a view. But yet, when they were converting, they were selling like hotcakes. In your opinion, Mike, how much more is happening down there? And is it rental? Is it condo? And is there as much interest in buying or renting in that neighborhood as there has been through the years?
Yes. So there's a ton of luxury rentals coming to the market in the financial district, which is phenomenal because they really are great buildings. The developers are doing a phenomenal job.
They are.
We look at Pearl House at 160 Water. They came in, and it is a stunning conversion. Everything is great. The floor plates, to your point, are massive, but they did such a good job. They really utilized the home offices, which people are starting to love because they can't necessarily afford a 2-bedroom, but maybe they don't need the window in the second bedroom.
Correct.
So the home offices are a great solution to that. From the sales side, if we look at something like One Wall, they have been having some trouble. There was an article in The Real Deal. I spoke with Harry Macklow about this.
He's always had trouble. Equity.
Harry?
Yeah.
He's a great guy. But One Wall is
pricing. It's always about pricing.
It absolutely is. They have units listed for like $3,900 a foot, $3,800 a foot, and 56 Leonard is, a lot cheaper than that on resale. So
and a better
it's
neighborhood.
Tough. 130 William was a really, really strong building. That was obviously ground up, so we can see kind of the juxtaposition there. But overall, I think the conversions are great. You look around the financial district now, and it's just basically luxury apartments, which I love.
And there are places to have a cocktail and places to eat.
There's a lot of great places. Yeah, a lot of great restaurants. I think it's a great neighborhood. If you can get a great deal, because
it's a great neighborhood for a lot of reasons. One of the reasons I loved it, even in my work days down there, was the commuting was amazing from any part.
It's the best.
From any part of our city. You can get there. Everything ends and starts right there. It's amazing from that perspective.
And one thing I do want to note is, I said I wouldn't recommend buying in the financial district, which I think is true. If you're buying something to rent out, that's going to be an issue. But I have a lot of clients that I'm working with right now in that kind of $3 and even up to like $7 or $8 million range. And they're kind of pushing south from Tribeca into the financial district. And there's a lot of deals to be had right now, which is very, very exciting. Because they're not going to be renting these out. These are pied-à-terres. They don't, so they're basically focused on 10, 15-year appreciation instead of like the monthly revenue. So that'll be really exciting. I love the financial district, if you can't tell. I could go on for hours.
No, I have learned to love it more than I did when I worked there, because when I worked there, 4 o'clock, the streets would fold up, all the financial people.
Yeah. It was totally different back then than it is
exactly.
now.
That's what I'm saying.
Now you have the South
We're
Street
talking about the
Seaport,
90s. It was dead. Dead zone.
It's become a completely different neighborhood.
Yeah.
It's actually fun and exciting.
It's actually a neighborhood
Yeah.
now. It's actually a neighborhood.
Yeah.
Ben, you mentioned before the city of yes, and I want to just pick your brain a little bit about, what is expected, or how is it expected to shape some of our new development projects this year in 2025 going forward. The mayor signed off on that, less than a month ago? It's a little controversial, but yet there are some really good points to it. Explain to our viewers and listeners a little bit about what you know about City of Yes.
Yeah, I know a limited amount. I know more than some, but we've been trying to work with the professionals to get a better understanding of this and find where the opportunities are. As we mentioned earlier, it's a step in the right direction. I think developers, architects, and people like that who are on top of some of these nuances. Like anything in the political scene, there's always things that are getting traded. You know, you got to trade the good with the bad to get some things through. But when you look at the good parts that have been, you know, looped into the city of Yes, again, there are some elements that will make the movement of the projects, right? Because time costs money now, right? With the interest rates and things like that. So there are pieces of it that will make that a little bit easier. There are pieces of it that'll bring the construction cost down on a buildable, you know, square foot basis, just with changes in zoning and regulation. How you put those together and assemblage and things of that nature is really, you know, key to find the right projects. So again, there will probably be a slight bump up from where we've been on the margin because you have enough developers. The reason why there's so much that goes on in the financial district is developers want to develop. Developers are the cash poor people. And, you know, if there's a project to be had, they're going to, you know, try and make that work. So I do think you're going to have people that, again, see the opportunity, do the right amount of homework, and we're going to see a little bit on the margin. There's nothing that's like home runs like the 421As, but, you know, there are these little pockets that I think will create some real, you know, nice things for developers.
We talked a little bit about about investors, you know, and how they may be stymied because of cap rates and a whole bunch of other things. But coming into our market, you know, we've always taken great advantage of foreign buyers from all around the world, different places, different countries, whatever. Foreign buyers here as investors, some buying for their children who are going to school here, some just buying to have a pied-à-terre, you know, when they come and visit New York or the United States. Patrick, what do you think the foreign and for years, okay, for a whole host of reasons, you know, they kind of backed off, right, and were not really present in our town. Do you predict in 25 that may change? Do we see a little bit of an uptick in their activity, or does it stay flat the way it's been? I mean, it's changed a little bit positively, but not where we really want it to be.
Yeah, foreign money is always been a big part of the real estate market here, and even if it feels like it's died down a little bit, it's definitely here. I live in the West in Hell's Kitchen, and I'd say half of my neighbors are foreigners, and I talk to a lot of them, and it's usually family money, you know, that they sent over here. And I, you know, with my own listings, I'd say about half of the people who come through are parents with their kid who are either coming here for school or coming here for a job, and it makes a lot more sense for that family to, you know, put some money down here in New York than to throw the money out, you know, at the landlord and have their son or daughter, you know, paying way too much in rent. So yeah, I mean, foreign investors, foreign money has always been, you know, a fundamental part of our backbone.
You know what always
interests
me though, when I get a client, you know, especially in a lot of condos, and you know, a foreign international buyer is coming from wherever, and they're buying an apartment for their son or their daughter because they're going to college. And they don't want to live in a dormitory. And so I want to buy them an apartment so they can live comfortably and whatever.
Very nice.
And I just say to myself, why didn't I have parents like that?
Yeah.
Right?
Well,
okay, really?
Can I
keep it going?
Yep.
Nothing wrong with it.
Can I throw out a really interesting statistic that in prepping for this I came across? So over the last 10 years, New York City has increased its number of millionaires by 48%.
Correct.
The number one city in the entire world, most millionaires in terms of city in the entire world, is New York City. We are the capital of those types of people and millionaires. So when the dollar is high, like it is now, and our currency is strong, right, which happens when interest rates also go up, again, we're viewed as a safe haven. There's so many, you know, variables that are at play that can both be good and bad at the same time. But like when you look at those things, we're such that like center of you know, wealth for really the entire world and sort of safety net with things. So
big old New York City, the financial capital of the world, the most invested city in the world, the place to be for most people who don't live here but want to be here and eventually get themselves here. All right, predictions for the rest of 2025 as we start 25. Mike, from a rental perspective, in regardless of neighborhood, where do you see the rental inventory moving forward, and where do you see the renters going forward? Strong market, flat market, continuing to increase activity-wise, not necessarily pricing. You see a lot more activity coming up in 25?
I think it's going to be a very I don't want to say a very strong market. It's definitely going to be a strong market. We saw this past summer of 24 in terms of rentals was very odd. I think we all felt that it was a weird summer, whether you're in sales or rentals. A lot of the agents that work with us, they were feeling weird. But, as like this first couple weeks of January have been phenomenal. People are reaching out like crazy. They're reaching out even now being like, hey, I want to move in June. I'm just so excited. So, there is really positive sentiment going towards it. I think it's going to be really, really strong basically across the city. I think a lot of people are going to start coming back into New York City, as we've noted, into Manhattan, as everything kind of starts to level out. Like Hoboken's getting very expensive. Brooklyn's getting very expensive.
Everything. Jersey City. I was looking for somebody in Jersey City. Way high.
Yeah,
way high.
I wouldn't take the PATH
You're
train
not saving
for those
money.
prices. Yeah,
You're not saving money.
We're saving money, and then you got to commute on the PATH train. All right, give us a 30-second commercial on your marketing company, Real New York City Apartments.com.
Yeah.
Tell us about it. And how you can find a rental.
So Real NYC Apartments. So we do rentals and sales. I specialize in rentals, but we have agents that work with us who absolutely do sales. Like Burton Frey is a phenomenal agent if he's watching this. So what we do is we utilize social media to share 1 minute apartment tours with millions of people. We reached 30 million unique people last year. We hope to double that this year. So
social media.
2025 is going to be the year of social media. Everyone is moving towards it. We've seen the sentiment really shift.
Hopefully we don't lose TikTok.
Don't even. No. I don't think we will. But if we do, it'll die in something new. Yeah.
But it'll come back somehow.
We're seeing developers, brokerages. Everyone is really getting used to social media, and they're really starting to appreciate it. So you're going to see it really, pull a lot from Street Easy, where people are going to see brokers that they like the personality, they want to work directly with them, or they see apartments that they like directly on TikTok and rent it from there. It'll be really interesting 2025.
It's a great website, a lot of good information. The videos are top shelf. Patrick, so your predictions, forecasting for 2025 as we begin the new year. It's only January. Where are we going?
We're 2 weeks in.
Only 2 weeks in.
And as we started this, I mentioned I don't recall a busier first 2 weeks of any year.
Right, and
that I've been doing this for almost 16 years. I think when it comes to the rental world, it's going to be steady and flat. I think people are still going to keep renewing because it's expensive. No one, first of all, wants to move. Secondly, they don't want to have to pay a broker fee, and they will up until. Well, that's
June.
up until June. But
that's another whole. That was last week's show.
That was
last week's show.
I mean, that rabbit hole.
Because there is so much engagement in the market, I do think we'll start to see people who are paying way too much in rent, opening the door to like do-it-yourself co-ops, co-ops that need some work, they just want to give back to themselves instead of pay a landlord's mortgage. I think the overall sales market is going to be strong. Again, the amount of phone calls and emails and conversations I've had in just the last 14 days is it's been almost overwhelming, and I think people have wrapped their head around the reality of interest rates, the global politics, and the world that we live in, and New Yorkers just want to be happy. So a lot of times that means
live their life.
Exactly. A lot of times that means getting the home that they want.
Absolutely.
And they're willing to pay a premium for that. So I see 2025 as a very, very strong year.
I agree. Ben, wax poetic for us. Close us out.
Again, as I started it off, Venn diagram, great challenges, great opportunities. And what I see with that is, we're seeing a huge surge in the upper end of the market and the luxury market, 55% growth, 7 to 15 million, 15% growth, 3 to 7. So, with all of that, I think you're going to see the return of, and we also are in this supply constraint, which we didn't even talk about. That's gone down over the last 2 years, 10 to 11%. So you have a supply squeeze in our market. You have a lot of demand coming in from a variety of different things. What that is causing is I think you're going to start to see more of those FOMO buyers actually enter our market for the spring season. That said, I think macro variable-wise, we have very frothy markets in the equities, which does also impact us as well. We haven't seen a hit to that and how that, plays in, but that always rattles us a little bit. So I think you're going to see a few moments of like macro instability, but the underlying dynamics of our market are strong enough to not only probably just at least be stable during those, but when we come out and there's the settling of these forces, as long as we keep trending in this direction, we're due to really pop out and really break out of the trend that we've been in the last, couple of years. So,
Amen.
Amen is right. And positive thoughts going forward. I also agree with these guys that 2025, it almost has to be. But as everybody has been saying, FOMO, and you can't keep New Yorkers down for very long. I do believe, though, that 2025, we're starting out strong, and let's hope we continue. Ben, Mike, Patrick, great show. We're coming right back with my thoughts for the week. Don't go anywhere.
Hey, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you hear a lot about how crucial it is to have the right partners in this industry. At Roadway, we don't just move your clients, we give them an experience they'll love. Specialized services to our white glove treatment, it's all about making sure your clients feel taken care of every step of the way. And if you're looking for a rewarding referral program, reach out to me at steven@roadwaymoving.com or visit roadwaymoving.com.
All right, everybody, we are back with my thoughts for the week. So navigating 2025 New York City real estate forecasting requires a blend of data analysis, adaptability, and strategic planning. Market conditions are influenced by interest rate trends, shifting buyer preferences, and policy changes like office to residential conversions. Understanding these dynamics is crucial for stakeholders, whether they are buyers, sellers, or investors. To deal with uncertainties, it is essential to focus on localized market data, such as neighborhood-specific demand, and prioritize properties with features that align with evolving lifestyle trends like sustainable designs and high-value amenities. Diversifying investments and maintaining liquidity can help mitigate risks associated with fluctuating mortgage rates and economic shifts. Ultimately, staying informed about macroeconomic conditions and micro-level developments will empower professionals to make well-timed and informed decisions. And that's our broadcast for today. Thanks to my guests for being here on set with me. You can follow me always on Facebook, on Threads, Instagram, LinkedIn, Blue Sky Now, or TikTok at Vince Rocco. And Eleanor Roosevelt used to say, if life were predictable, it would cease to be life and would be without flavor. And from all of us here at Talking New York Real Estate and the More Network to all of you all around the world, thanks for spending a part of your day with us. I am grateful, and I will see you next time. Goodbye, everybody.